This video explores the fascinating history of money, banks, and stock exchanges, from bartering in ancient Mesopotamia to today's digital financial world. I'll explain how our financial system has developed over thousands of years, highlight key milestones, and show how banks and exchanges came into existence. Over 4,000 years ago, merchants in Mesopotamia began exchanging money. They traded grain or metal for goods. Temples and palaces stored valuables like gold. This marked the beginning of banking activities. Around 600 BCE, the first coins were introduced in Lydia, modern-day Turkey. They were made of electrum, a mix of gold and silver. Coins simplified trade. Merchants stored them in secure warehouses. In the 5th century BCE, the first banks appeared in Greece. Money changers, called trapezites, exchanged coins and lent money. They also managed deposits for wealthy citizens. Temples often served as secure vaults. In the Roman Empire, bankers known as argentarii were very active. They lent money, exchanged coins, and managed wealth. Markets in Rome had banking stalls, much like today. Promissory notes were used to transfer money. In the early Middle Ages, trade was simpler, but money changers were essential. They exchanged coins from different regions. In 12th century Italy, the first banking houses emerged. Merchants needed them for long-distance trade. In the 13th century, Italian cities like Venice and Florence founded banks. The Medici family in Florence became especially powerful. They lent money to princes and merchants. Bookkeeping was invented to track transactions. In the 14th century, the Bill of Exchange was introduced. It was a written promise to pay money in another location. This made trade safer, as merchants didn't have to carry gold. Banks frequently used these bills. In the 16th century, the first stock exchange emerged in Antwerp. Traders met to exchange goods, promissory notes, and shares. The exchange was a place for price discovery and trade. It served as a model for future exchanges. In 1602, the first modern stock exchange was founded in Amsterdam. Shares of the Dutch East India Company (VOC) were traded there. People bought and sold stocks to earn profits. The exchange attracted many investors. In 1694, the Bank of England was founded. It was one of the first central banks and lent money to the government. It also issued trusted paper money. This was a major step forward for banking. In the 18th century, many countries adopted the gold standard. Money was tied to gold, making its value stable. Banks had to store gold to back banknotes. This supported international trade. From the 19th century onward, the Industrial Revolution boosted banks. Factories and railways needed large loans. Banks like the Rothschilds financed projects across Europe. Stock trading grew rapidly. In 1720, the South Sea Bubble occurred in England. Many bought South Sea Company shares expecting big profits. Prices rose, then crashed. Many lost money and stock markets became more cautious. In 1792, the New York Stock Exchange, later Wall Street, was founded. Traders met under a tree to trade shares. The exchange grew quickly and became a symbol of capitalism. Today it is world famous. In the 19th century, savings banks emerged, especially in Germany. They were intended for ordinary people wanting to save small amounts. Savings banks were safe and paid interest. They made banking accessible. In 1929, the New York Stock Exchange crashed, triggering the Great Depression. Stock prices fell, and many lost their wealth. Banks failed as customers withdrew their money. Governments imposed stricter regulations. In 1913, the Federal Reserve Fed was established in the U.S. It is the central bank and manages the monetary system. The Fed influences interest rates and money supply to stabilize the economy. It is very powerful today. In the 20th century, investment banks like Goldman Sachs became important. They helped companies issue stocks and funded large projects. They also traded complex financial products. Their influence grew enormously. After World War II, the modern foreign exchange market emerged. Countries traded currencies like dollars and pounds. Banks exchanged billions daily to support trade and investment. The Forex market is massive today. In the 1970s, computers entered banks and exchanges. Trades became faster, and data was processed instantly. Electronic exchanges like NASDAQ appeared. Trading became more digital. In 1987, stock markets crashed globally on Black Monday. Computer programs worsened the crash by selling automatically. Many lost money, and exchanges introduced new safety rules. In the 1990s, online banking started. Customers could manage accounts and make transfers on computers. Banks like ING Direct made it popular. It was convenient and transformed banking. In 2008, a global financial crisis hit. Banks had sold risky mortgages and many collapsed, like Lehman Brothers. Markets plummeted and governments had to bail out banks. The crisis affected the entire world. In 2009, Bitcoin was introduced as the first cryptocurrency. It works without banks and uses blockchain technology. Many people invest in crypto, but prices fluctuate heavily. It's a new form of trading. Since 2010, fintech companies like PayPal and Revolut have grown. They offer fast digital banking services via apps. Traditional banks must adapt to keep up. Fintech makes banking easier. Today, many invest in sustainable projects like green energy. Banks and exchanges offer green funds and stocks. Customers want to put their money into eco-friendly companies. Sustainability is shaping the market. Exchanges like Frankfurt or Tokyo are highly technological today. Trades happen in milliseconds, often via algorithms. Small investors can trade through apps like Robinhood. The market is more accessible than ever. Banks and stock exchanges are vulnerable to hackers. Criminals try to steal data or money. Banks invest heavily in cybersecurity to protect customers. It's a major concern. Central banks like the European Central Bank steer the economy today. They set interest rates and print money to prevent crises. Their decisions influence markets and banks worldwide. They are more powerful than ever. Banks and exchanges are becoming more digital and sustainable. Artificial intelligence could assess loans or control trades. Cryptocurrencies and blockchain could reshape banking. The financial world is evolving rapidly.